Don't you guys hate it when you see a pool paying like 10,000% APR and then as soon as you deposit, it goes to zero, or at least the next day it goes to zero? Well, in today's video, I'm going to show you guys a couple of different protocols you guys can use that will allow you to earn a nice dividend and a pretty good investment. So today, we're just going to go over a couple of them. It's probably going to be like 5 or 6. And then we'll go ahead and get into it and show you guys what's up. So the first one is GMX. So I'm going to shrink my face so you guys can see what's up. But GMX is a real yield protocol because you are actually having traders who are getting a benefit, whereas the guys who are depositing as a LP, they're also getting a benefit. And the yield is actually coming from the traders. So when people deposit onto GMX in the GLP pool, they're taking the other side of the trade. And for the most part, traders typically lose. And you can take a look at the GMX dashboard and you can see most of the time traders are at a loss. However, with this little bull run, traders are tending to win. Now keep in mind with GMX, the winnings are capped. But when you're depositing in the GLP pool, the TLDR, what you need to know is if the traders are winning, the stakers or the LPs are actually losing. And if the LPs are winning, which that's when the traders lose. And that's where the yield is coming from. So it's basically coming from those guys, and it's skewed into the LP provider's favor because there's fees involved. Whereas if there were zero fees, then it would be like a 50-50 situation or like whatever. So just something to keep in mind. Traders, there are times against them. And currently the GMX pool is actually paying nuts and ham right now. If you're staking GMX, it's only like 11% or 10% in ETH. And depending on how much GMX you have or how long you've been staking, it's actually more because they have multiplier points. But TLDR for the most part, let's call it around 10%. Now, for GLP, on the other hand, this is going to give you exposure to ETH, USDC, Bitcoin. I'll show you guys the weights and pairs in a second, but you're getting around 50% APR in ETH. So you're having exposure to some crypto assets. So if the crypto assets go up, you also get that exposure. I mean, you are going to have some stable coins, but you're getting paid 50% in ETH. And if you take a look at the dashboard, you can see the weights of the different tokens. You're going to have exposure to some ETH, some Bitcoin, some Link, Uni, some stable coins, just something to keep in mind. As you can see here, this is like a little GLP price comparison that they've had. This is since inception. The GLP with the yields included, it's actually outperforming the rest of the junk. Like GLP with fees, you would be sitting around $1.43. Whereas with something like BTC USDC, you'd be sitting at 90 cents and ETH and USDC around 85 cents. So because the impermanent loss. And the GLP price, as you can see, it actually is holding up pretty well. So it's actually better that you were holding GLP if you were doing something like Bitcoin. Obviously, you want to hold straight up Bitcoin in a bull market, but this is something to keep in mind, and this is the analytics page on GMX. So if you ever want to check this out, you just go on to gmx.io, go to the dashboard, and boom, stats are right here. So the very first protocol you guys can use is GMX. This will give you exposure to the GMX token if you're simply just wanting to stake it, or you can have exposure to a basket of assets and get the real yield from this, but you do take on the risk that the traders are going to win. And as you can see from this data, most of the time the traders lose, but in a bull market, they do outperform. But obviously this does revert to the mean as more people just go gig along. And then when they go gig along and it dumps, they get liquidated and GMX and the stakers profit. Something to keep in mind. Now the next one is Gains Network. Now Gains is not that bad. I actually like Gains pretty well. This one, you're actually going to get exposure to GDAI. And as you can see here in the analytics and data, on average, the GDAI Vault to TVL APR ratio, it's going to be around, I don't know, 10, 20%. I would call it about on average 20% because you can see up here is around 30% and down here is 10%. The only exposure you have in the GDAI Vault on GMX is just going to be to DAI. So when you're staking GDAI, you'll simply deposit DAI in here. And as you can see here, it actually is overpriced right now because the yields are actually compounded into there, and there are a couple of other farms you guys can use in DeFi. But in general, you can look for about 15 to 20% APR just on a stablecoin. Keep in mind you're taking the other side of the traders, so if the traders are profitable, you will be, well, losing. And if the traders are losing, then you'll be winning, and hence why you have this APR. If you don't want exposure to like the trade and loss, etc., then you can just simply stake GNS. Keep in mind this is a ultimate backstop if like GDI becomes under collateralized, etc. But for the most part, you're going to earn around a 8 to 9% APR. I would say choose Arbitrum because it has most of the volume. But that's just going to be paid in the DAI stablecoin. And this is a real yield protocol because this is actually coming from traders who are using the platform and trading. It's not just something out of inflationary rewards. It's actually coming from the trading volume that's on Gains network. On average, it's about $100 million in trading volume daily. This is just Arbitrum. It also has trading volume on Polygon, but that's something to keep in mind as well. That's the second protocol. So first, GDI, you can stake that, get around 15 to 20% APR. And then you have the GNS token or Gains Network, whatever you want to call it. This is going to earn you about 8 to 9% APR on Arbitrum. The third protocol is Level Finance. Now, Level Finance is an interesting one. It's not a strict GMX fork, but it has something a little bit different. Instead, when you're providing liquidity on Level Finance, you actually can get exposure to a couple of different tranches, depending on your risk tolerance. If you want something that's lower risk, less exposure to things like Cake, ETH, Bitcoin, and more of stablecoin exposure, you can look into a lower risk tranche. And if you want more exposure, you can also go with the middle to high risk, and these do pay different APRs like 113%, 141% for the middle, and 203 for the junior tranche. Now let's say, for example, you want to go ahead and earn with some of the level tokens that you have. You can choose to simply stake and earn some LGO. Keep in mind of the 4% deposit fee, so that's something you have to pay in, but you'll get 76% APR paid in the LGO token. This LGO token is redeemable for some of the treasury assets. These liquid assets change from time to time, but mainly this is earned as more and more traders are on the Level Finance platform. Or if you simply just want to stake your LVL token and get paid out in an APR with real yield as well, this is going to pay you in the tranche token. So if you're staking LVL, you're actually going to earn some of the senior tranche token. And the LLP token is priced around $1.25. So depending on how much you deposit into there, you can earn different tiers or different amounts of the token based on how long you're staking and how many tokens that you're staking. The LVL token, of course. Of course, it's not going to load for me, so you can also stake your LGL token and earn some of the tranche tokens as well. That's going to pay you about 100 to 110% APR. So again, you have that form of real yield. Now, that's not factoring in the LVL token that's emitted in order to stimulate this trading volume, because it's like a trading competition. But a lot of protocols will do this in order to stimulate some of the yields. Another example of one on Arbitrum is Vela Exchange. And as you can see here, most of the trading volume is from leverage on Level Finance. So this is healthy to see for this type of protocol. And the reason why I know it's leverage trading is because it's in purple, and you can see it says here leverage trading. Just something to keep in mind. Like, what I wouldn't want to see on this analytics dashboard is something that just says swap fees. Now, compared to something like GMX, which has several thousand unique wallets, and Level Finance only has a couple of hundred, it could be some wash trading here and there, but the yield is actually real yield. So there's actually people trading. The actual money and fees that they're paying to be in that trade, it's actual revenue into the protocol, even though it does have a little bit of a wash trading. So something to keep in mind when you're using something like Level Finance. So that was the third protocol. Now the fourth protocol is Lyra Finance. Lyra Finance has a couple of different vaults, like the ETH vault, Bitcoin vault, SETH vault. You also have the SBTC vault. This is on Arbitrum and Optimism. If you haven't seen what Lyra Finance is, make sure you guys check out the previous video I made on it. It's basically a options platform. An option gives you the right but not obligation to buy a particular asset. Why would someone prefer an option over simply buying 1 ETH or 2 ETH, whatever? You can get the exposure to that asset for a fraction of the cost. So an example is if I wanted 1 ETH exposure, it may only cost me like $100 on Lyra Finance to have exposure to that option for like a week, 2 weeks at a particular price. So I get the upside to ETH without the upfront capital. So if you want more clarity and understanding on that, check out the full video I made on YouTube. But on average, you get about 20% APY. And if you have more Lyra tokens staked, you're actually going to earn more on this. These yields are a little bit subsidized by the Lyra token and the OP token. But for the most part, these yields have actually stayed around the 20 to 25% APR rate for a good amount of time. And the reason they are doing that is because these vaults are very important for the protocol, because if those vaults aren't there and the liquidity is not there, people can't trade the options. And as you can see here, over time, the pool performance has been pretty steady, staying around peg or even going above peg. And the pool performance, you guys can see here, 103, 99%. On average, it stays around 1-to-1. Sometimes it'll be more, sometimes a little bit less, but you have that 20% APR to offset that. And then, of course, you have the same thing with the trader's profit and loss. People are profitability, it's taking from the vault, etc. That was the fourth protocol. The next protocol is going to be Equalizer Finance. Equalizer Finance is a VE33 fork. And basically the emissions you're going to get out of this is going to be in the equal token, not in swap fees. But this pays a consistent amount over time because people are incentivized to buy and stake the equal token in order to earn the additional yields from the volume as well as bribes. I'll show you guys that in a second, but you can see here stable APRs. You're going to get around 10%, sometimes more, like this one's 13%. Really just varies based on time to time and what the votes are for that particular pool and if they bribe in some of them. You can see here the fees over time on Equalizer, they are constantly up only. This is paid to the stakers of the equal token. They also earn a portion of bribes, and the bribes over time have steadily been increasing as well. But the trading fees as well as the trading volume have steadily been increasing over time, as well as the bribes that have been paid. They have constantly been going up. I don't have a dashboard on the bribes, but I've been watching Equalizer in the Discord and their bribes that they get every single week. It's nuts and ham, and it's steadily taking a stair step up over time. And you can also simply go on Equalizer Exchange and click on the vote, and you can actually see some of the bribes. Here are the bribes plus fees. As you can see here, just for the USDC and Phantom pool, it's paying out $56,000 for anyone who votes for that. You got another one for 14, you got another one for 12, and the APRs for this are even more. We are looking at this before it's even close to epoch time. Epoch time happens on Wednesday. I don't know when you'll be able to see this video, but when you do, usually around Wednesday or the day before Wednesday, check out the bribes and fees. They're usually filled up by other protocols voting for different pools in order to get more of a yield. The reason why they're willing to pay these pools is because me as a equal holder or you as an equal holder, if you're voting for any of these pools, it sends emissions that way. When emissions go there, the APRs are higher on the liquidity pools. So if I see something like 500% right here, I might be incentivized to deposit liquidity there. And let's say my protocol is Banana Coin. Well, you have USDC and Banana Coin. I incentivize this pool to get some votes because I paid Banana Coins in the bribe pool. So I'm bribing people who are holding the equal token to vote, and so I can get some APRs. When I get APRs, more people deposit liquidity. I get liquidity for my token at a cheaper price than I normally would for giving out my Banana Coin. Another one just like this is Velodrome. As you can see, Velodrome, 16% on stable coins, 11%. It's really not that bad. Some of them pay even higher depending on how high the bribes are. But take a look at Velodrome and Equalizer. They've been around for a good bit of time. There's some solidly forks, and the exposure you're going to have is in stable coins. And as you can see here, the fees per pool, if you are staking some Velo tokens, it's paying out nuts and ham. And if you're getting bribes, the last round it paid almost $1 million in bribes. You can see here that it's steadily climbing up. And the guy who seems to bribe the most is going to be the USDC and dollar. Remember, USDC and dollar, right? They pay the most bribes. Let's go ahead and take a look at their APRs. You can see here their APRs are 16%. The reason for that is because they're paying the most. And you can see how much liquidity they have in here. They got over $30 million in liquidity. Actually, that's like $35 million in liquidity. But the reason why their liquidity is so deep and they still have a high APR, not APY, is because they're bribing this much. Now, keep in mind it is in the Velo token. So if the Velo token goes double in price, the APRs double. If it gets cut in half, the APRs get cut in half. But still, 8% is good on a stablecoin, and 32% is even better on a stablecoin. But you can see here the bribes over time, constantly going up, fees going up. So if you're staking Velo, you're going to be earning a lot. Now, the next one, you can consider this the sixth one, is Pika protocol. Pika protocol is on Optimism. This is similar to something like GMX or like Gains Network. You are able to trade in the different pools. And if you're depositing into this vault, which is just USDC, this is not risk-free. Your rewards, they always go up, but your deposit could go up or down. Your vault reward is going to be paid in USDC as well as the Optimism token. You're taking the other side of the trade. So if traders win, you lose. If traders lose, you win. And over time, as you can see, the profit and loss of some of the closed positions, over time, it's actually negative. So they're losing more on average. So the vaults are actually profitable, and then you're getting the USDC and the OP token at a 17% APR. And paying that rate for a steady amount of time, and as you can see here, it sits around sometimes 10, sometimes 22, but on average, it'll pay you like 15%. As you can see, at one point in time in September, it was paying over 40%. But on average, you're going to get around, let's call it 15%, something to keep in mind. The next one is Rage Trade. Now, Rage Trade, they don't have a token yet, so you could potentially get a airdrop with this one, just using this protocol. But if you're depositing into here, depending on which vault you deposit into, you can simply do USDC, or you can do some GLP, just depending on if you want to take a risk on or risk off. Make sure you take a look into it. You got to understand if the traders are profitable in this situation. Again, you lose. But if the traders lose, you actually win. So you're getting some nice APRs. But this is another one that you can look at. And lastly, one a lot of people don't really talk about much is Cap Finance. Now, Cap, you can actually deposit into some of these pools. This is on testnet, but you also got ETH and USDC as a pool, and it pays around 40% APR. It says 20 to 60%, but you're getting 10% of all the trading fees. The other 10% goes to the cap stakers, and the other 80% goes to the treasury. Maybe they'll flip on a fee switch so it gets more, but this is a form of real yield and sustainable dividends as long as the trading volume is there. It's not something that's out of inflationary rewards like a lot of these protocols do. Now, the eighth and last protocol I want to talk about is Taro.to. This is a leverage yield farming protocol. I know you're like, wait, this dude just told me he's not going to be showing me some inflationary tokens with farming. Well, technically it's not. This is a leverage yield farming protocol, so it can pay extremely high APRs to people who are willing to deposit some liquidity for these farmers to leverage up their position. What happens, as you can see here, as I'm leveraging this, or if I want to leverage my LP at 10x, Taro, it's a fork of Impermax. It allows LPs to be able to deposit and use the LP as collateral to borrow against it and then buy more LP to basically maximize the returns they get. So as you can see here, at 1x leverage, they would get 104%, but at 10x leverage, they would get 813% APR. Now, you aren't going to be getting like the 813%, but you can see here, you can single side deposit some DOLA token, which is basically a dollar stable coin, earning around 11%. I'm not saying DOLA is a good stable coin to use. In fact, do your own research and look into it. I'm not saying it's a bad stable coin. I'm not saying it's good. I'm just saying make sure you do your own research. Just because it's called a stable coin doesn't mean it's stable. But if it does stay stable, you're getting around 12%. Now, if you want to look at something like USDC, You can get 13% in this vault. Depending on the token that you want to look for, you can look for higher yields. So let's take a look at ETH to see if there's any higher yields on ETH to see what the rates are going for that. Sorry, my computer is a little bit slow. I'm kind of recording. But you can see here on SETH, which is the Synthetics stablecoin ETH, and it holds its peg pretty well, is 8.4%. And then you also have 4.68% on straight up ETH. And as we search for USDC again, you can see here the best one pays 13% APR here. This one pays 17% APR. So they all range from different. Oh, as you can see here, this one pays 60% APR. And that's on a stablecoin. So you just have to surf around and look on Taro, and especially as other farms pop up, you'll be able to take advantage of the APRs. But do keep in mind the utilization rate. Like this one's at 100% right now. You can't really withdraw until there is more liquidity there, because there is a leverage yield farming loop. Or as people get liquidated, then you can get some liquidity. Anyways, guys, that's like 8 or 9 different protocols you guys can use to look for some sustainable / real yields. If you guys want to check out to see what I'm doing in the market, you guys can check out the Discord. Links in the description below. I share a lot more content there, and I'm more active over on Discord. A lot of stuff I don't even share on YouTube, as well as some other DeFi degens just like you, just sharing alpha here and there. Check out that in the description below. And let's hit you guys with a wisdom one-liner. Proverbs chapter 11 verses 7. Hopes place and mortals die with them. All the promise of their power comes to nothing. Don't put your faith in a human. They're mortal just like you and have the same destination. What really matters is after death, where you're going. Anyways, guys, thanks for tuning in. Peace.